Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi. Happy Friday to you, Jim.
Bob, we love to answer listener questions. We have a couple of them today. The first one comes from John. Bob, I'd like to think of what can happen the opposite of what I think. You think the market will crash this fall? What circumstances would make you wrong? Maybe interest rates remaining low. Can the Fed, Bank of Canada, etc. continue to prop up the market? Also, if and when the market crash happens, I'm sure there will be massive dip buying. When do you see another big wave down? And then do you see a multi-year flat market? Thanks, John from formerly Free BC.
Yeah, it used to be free. Good set of questions. I never like to call a crash ahead of time. I usually use the liquidity crisis, forced selling, that sort of thing. And quite simply, we're on the path. As we've been talking, Jim, the financial markets, stocks, bonds, and commodities would all be favorable into around mid-year. And then there was a chance that the U.S. markets would rally into September. But within this, August would be a transition month for some of the games. And some of the key commodities started to correct. One of the key items is credit spreads narrowing. That's for the party. And then credit spreads have narrowed into May or June, into around June, which was likely, and then they have since reversed to widening, which always signals a contraction. And now, all it needs in here now, it's been sort of flat trending for a few weeks. It just needs to break out. So the question about the market going up, I think it's best answered, Jim, by that when we expected the market to be hot and rallying has come in. And also it's become technically excessive, which suggests the top. But if it wasn't technically excessive, the action could probably continue. So this is the key point. Hot when it should be and measurably hot. Okay? Then the other question was the Fed or the Bank of Canada coming in and being able to support. Well, they've had the money taps turned on for years. And they've also, in previous big bull markets, have had the money taps turned on. And as always, the speculation becomes excessive, and when the contraction starts, the control, the power shifts over the margin clerks, and every time they overwhelm the powers of the central bank to keep the party going. And you just want to take a look at how many bull and bear markets there have been since the Fed was formed. So if the Fed theory, or the theory that the Fed can keep a boom going, if it worked, there would have been no bear markets. So, I think that, and in particular this week, there's a couple of items that have taken steps towards a crisis, and one is the gold-silver ratio is very strong, and you've also got some, the spreads are not exciting here now, but you've got on the advanced decline line, it, after supporting the rally very well, for the last few months has turned choppy. And choppy up and down kind of action last seen in 2007. So there's plenty of things that are saying that the market is on the path to a contraction, and we'll add to that contractions are often discovered in the fall of the year. So, I think it's time for most everyone to be lightening up and building liquidity.
Our next question comes from George. George asks Bob, how far will gold prices fall back to $1,000? Enjoy your historical content and knowledge on the markets. Your friend George.
Thanks for that, George. Gold is an interesting item because it really underneath it all represents money. And in a great financial mania, gold's real price goes down, and during the stock bubble, and gold stocks generally underperform the S&P. So the whole play got hugely overbought in July in 2020 when we advised that both traders and investors should take some money off the table. And so calling gold since then has been just strictly for traders. But myself and my pages that I write are mainly focus on gold stocks. And for, I guess 6 months now, we've had a target that they could weaken with a major decline in the big stock market, and then just took a guess that maybe into November. So as to whether gold can go down to 1,000, I don't know. I don't even study it. But what can happen here, it gets ironical because as you go into a contraction, gold's real price goes up. And as the real price goes up, the profit margins for gold miners improve. And then what you get in a post-bubble contraction or deflation is the time when gold stocks do very well. And you've had some fabulous bull markets for the gold sector in post-bubble contractions like the 1930s. But what you have here now is that it's the financial crisis that sets up the gold stocks for their unique bull market. So thus we're going to have patience. But as to the price on gold, I don't see it washing out too much because there's two things that go on in a post-bubble contraction. And one is that the very careful money goes to the most liquid items. And the most liquid items are sort of shorter than 1 year U.S. Treasuries, senior currency, senior market, all that sort of stuff. So that's the most liquid in investments you can get. And then the other item that is universally liquid, of course, is gold. So there can be a bid for the dollar because of buying U.S. T-bills. And, of course, there will be the main thing, what I look at, is the gold stocks. And there's a terrific buying opportunity coming there, maybe late October, early November. And on the next rallies for the gold sector, not only will it be rallying, but it'll be seriously outperforming things like the Standard & Poor's. So then eventually, with consistent outperformance, there's going to be a number of bond fund managers who would not buy the golds. They're going to have to buy them just because of the performance. So, yep, it's going to be very interesting, and thank you for your question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that caught your eye today. Nomura clients desperate for a dip to buy. What's the story there?
Yeah, actually, Jim, I grabbed that one because in early September of 1929, I think it was New York Times had a little article about what was going on, and that that investors and traders had finally realized that you had to buy every dip. Of course, it gets really interesting because you can't tell what the last dip is in a bull market until it's all over. So it has to take out the last. Now, we have a technical model that is designed to catch the best on a dip, and we call it the springboard buy. Well, it gave one a week ago on the S&P. And somewhere, I keep thinking, now, is this going to be the last springboard buy? Now, that model is intended to provide the buy on a dip in a flat or rising stock market general trend. But in a bear market, that thing flips the other way, and then it gives you the technical trade on selling the rallies. So again, we can't tell the last springboard buy as it was last week until it's taken out. So yeah, an interesting headline.
World shippers' earnings have hit the highest level since the 2008 crash.
Yep.
Does that mean we're about to have another crash, Bob?
Well, that's going from A to B rather quickly. It's all over this tightness of shipping, not enough dock space, not enough container ships, da-da-da-da-da-da. And it is an example of a wonderful boom. And last week, there is the BDI, the Baltic Dry Freight Index for, dry freight, not tankers. And it has been going straight up for the last year and a half. And it is up to, technical excesses last seen when? 2007. So the headlines about the shippers making huge, combined with chart action that is saying peak, gets very interesting. And so perhaps all of this, and it is concerning about shortages of items, shortages of shipping, all this sort of stuff is concerning, but it is also a part of the end of a fabulous boom and bubble. So, and then I like it when we get a technical measure on the Baltic Freight Index, which relates to what's going on.
Now we have a lot of headlines that involve China's Evergrande, a giant mortgage company that's in crisis. There are now protests in China, and I think they're connected to the fact that Evergrande was encouraging its own employees to invest in their products.
Oh, yeah, and then many small investors were putting their money in by way of loans or bonds and getting an above market rate of return by way of interest rates. So, and that's always dangerous. So, unfortunately, it's a classic, and it ran its course and is providing a series of incredible headlines.
Yes, so with these protests across China, does this mean the Evergrande crisis, and maybe you can go into that a little bit, has become also a Chinese government crisis?
Oh, yeah. They, my suspicion, Jim, is that the communist government in Beijing are no longer your old communists that hated industry and business. I think they're all along the game, or most of them are, and probably making huge amounts of money and having it hidden out of the way and stuff like that. So, other than pride, they have their own pocketbook at trying to keep the bubble going. And but this thing with Evergrande is so big, and they're offering investors to swap debt for an actual apartment or something like that. So there's all kinds of desperate things going on. And what I like, why I've been following it, is that it's a colorful story, and it represents, it's not just one company, it represents many, and within interventionist central banking circles, they have a theory that in a boom, when it starts to falter, everybody knows, even back in 1900, that when you have a financial crisis, it leads to a recession. So with the formation of the Fed in 1913, the promotion was that Fed is lender of last resort. And actually, that actual term, lender of last resort, goes back to the 1873 bubble. So anyways, the lender of last resort will prevent the credit crisis, and then that will prevent the recessions. So this was the big deal behind the formation of the Fed, and there has been 18 cyclical recessions since the Fed opened its doors for mischief. And, Jim, you only would have needed one to disprove the theory. But there's been 18, and another one just around the corner. So, but when you and I look at the theory of the lender of last resort, I mean, it is very attractive to consider that there need not to be any recessions. You can just stay one happy investor forever. So, no, the theory does not work, and whether it's in China or England or Europe or the United States, they all have the same theory, because central bankers these days are not bankers. They're all PhDs in economics with the same theories. And again, once again, now this one can get interesting, because the public, a good portion of the public, is in a reform movement. They've had it with too much government. So there's going to be two levels on this. With a failure in the financial markets and recession, there are going to be some independent economists out there going to be able to, condemn it in scholarly terms, condemn central banking. And then you've got ordinary folk out there, and they know that the policymakers have thrown trillions of dollars into trying to prevent bad things from happening. And then when bad things are happening, those ordinary folk, like you or I, or listeners, are going to take a look and say, you guys are crazy. You may be experts, but you're crazy that you wasted trillions of our taxpayers' money and blowing it. Here, one jumps to mind here about the craziness of a financial bubble whereby Boeing, the great manufacturer of airplanes, was the board of directors got caught up in the stock markets, and they thought the stock was cheap, so they were doing stock buybacks to drive the market up, and they did something like over $40 billion of buybacks. At the same time, they were scrimping on the amount of money being done in the engineering for the new Boeing 737 MAX. And Jim, this is one of the most offensive things in industrial or commercial history, where the board of directors was playing market in the order of $40 billion and scrimping on, say, maybe $300 or $400 million to get the airplane right. I mean, somebody's got to write a book on this one. Maybe somebody already has, but it is, and to this really old investor and long-time financial historian, it is truly outrageous. But what it represents is that people go crazy in a great financial mania. Absolutely crazy. And the other one, Jim, is which I'm working on the book on, is that with this boom, you've had an absolutely wild, crazy market in politics. I mean, what's going on with the U.S. administration is utter madness. Pulling out of Afghanistan and leaving your enemy with $40 billion worth of very fine equipment for warfare is absolutely mind-boggling. So, to just touch the political side for a moment, that in 1920 culminated a huge global mania in commodities. Like the U.S. rate of inflation, they're now concerned because maybe it's at 7%. In 1920, the rate of inflation got up to 24%. And that was global. With it, you had the political crazies. You had the Bolsheviks in Russia making extraordinary advances. And in England, or in Canada, in the U.S., the socialists just went absolutely bonkers and were nationalizing railroads, intruding in this, intruding in that, and then Wilson intruded Americans into the war, First World War, and all that sort of stuff. And then, with the rising prices ending in 1920, and then the crash, and it was really severe because the U.S. rate of inflation went to minus 15% or something like that. But with that, you had a terrific change in politics. In the U.S., all of a sudden we're no longer nationalizing railroads. We're going to sell the railroads. And so the political tone turned from socialism to freedom and limited government, and then even that was part of the tout behind the big roaring 20s bull market, was that everything was no longer socialist, and there were going to be many countries opening up retail markets, and it was all wonderful. And even in Soviet Russia, they changed from hard communism to what they called the New Economic Plan, or New Economic Policy, the NEP. So the urgency of socialism was tied to the crazy mania, and then when the mania broke and financially, the politics deflated as well. So I think it's going to happen again. With this kind of a boom, a contraction is inevitable. It's just interesting as to when, but inevitable. And I would suggest that with the contraction, that the inflated bubble of socialism will collapse as well. And I want to tell you, I'm looking forward to it, Jim.
Bob, thank you so much for being on the show and answering all those listener questions.
Yeah, Jim, good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You can send your questions for Bob to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.